for the local market today. And for that, Stan Shamu is joining us from RG in Melbourne. Good morning to you, Stan. Good to see you. Tell us about this ECB interest rate cut. Not a lot of people saw it coming, as I mentioned. Is this just sort of reeking of fear coming from the central bank there?
Morning, absolutely. It's something that the market didn't see coming at all. I think a lot of analysts were actually expecting Mario Draghi to tee up the fact that he's looking at a rate cut and potentially actually announce it at the next meeting. But of course, the key mandate for the ECB is, of course, inflation and price stability. And following last week's CPI reading, which had disappointed, I think that really was the nail in the coffin. And that really did see or prompt the ECB to act last night. Now, of course, the major move was that in the euro, sharp drop down to 133 or just below that 133 level, its lowest level since September. And that really did spook a lot of the markets with the dollar index surging through to 81.46 at the time. But of course, we have since seen it come back a little bit. And of course, we have heard from Mario Draghi himself as well, just saying that it was a move, this rate cut was a move that the ECB was ready to implement. And at the same time, he didn't rule out another LTRO. So perhaps this is what's helped the euro find some buyers of those lows back above 134. But I'll still be looking to sell the euro into strength. I certainly feel that any moves back into that 135 region will be enough to warrant further selling in the euro. And of course, in the short term, I think that's the key strategy for most of these risk currencies, particularly with the greenback coming back to life. I think selling risk currencies into strength will remain the key strategy.
Getting back to this ECB cut, though, Stan, do you think that it will have the desired effect, spurring growth in the European zone?
No, I actually think it's a bit of a token move, really, by the ECB. A lot of talk was always around potentially negative deposit rates, and of course another LTRO as the moves that would probably have a bit more of an impact on growth going forward. There's also the issue of that asset quality review for the banks in Europe, which is coming up pretty soon, and that's probably going to have a bit of an impact on how the region works as well in the short term.
It's interesting because really some analysts are sort of saying that Draghi is just fearful of, deflationary, becoming the next Japan. Small segue into what you'd like to talk about next. We saw a really violent move in the US dollar Japan cross on the back of that US GDP data. So tell us why in particular in regards to that US GDP data.
Yeah, of course, it came in at 2.8%. The market was looking for a reading of 2%. But in reality, I think it's becoming a trend now whereby the US beats significantly or surprises higher on the GDP front. We saw the same thing back in July. And I think a lot of analysts actually highlighted the fact that there is the possibility of a surprise higher in this data yesterday. So that really triggered that move in the US dollar. It really helped the dollar index push through that 81 level. But of course, the key move was in the dollar yen. It charged higher above 99 into the 99.40 range, where it then found sellers and dropped all the way back down to around 97.80 or so. And I think the key was that the selling above 99 was actually coming or generated mainly from Japanese exporters themselves. So I think that's what triggered that weakness, and I think investors and traders just decided to add to those shorts as soon as they saw that trend higher in the dollar yen wasn't going to last long at all. And as a result, I think the Nikkei is actually going to lag the region today. We've got Japan called down 1.9%, set to drop below 14,000. So it's looking like a very poor day indeed for Japan.
And when we look ahead to the non-farm payroll data that we're expecting tonight, do you see that there's a lot of risk to the downside, or for that matter to the upside as well?
Yeah, I think at the moment perhaps this sell-off in the dollar yen's a bit overdone. I think this non-farm payrolls number, which is expected around that 120,000 mark, has the potential to actually come in line or just above consensus, and that should be enough to see a recovery in the US dollar. However, the sample size from which this data is being taken from was from right in the middle of the shutdown. So there is a significant amount of potential for it to disappoint, but I think the market's really priced in for a fairly benign reading on the non-farm payrolls front. So perhaps would have to look forward to the raft of Fed speak after that, being led by Bernanke himself. They might give a bit more of an indication of what to expect from tapering, because ultimately this payrolls number is expected to have an impact on the tapering issue. So whatever comments we get on tapering will probably be the key driver of sentiment in US trade later today.
Oh, and no doubt everybody will be poring over that speech, looking at every comma, every word in much detail. Stan, let's bring it back home. It's a Friday. Often we see sort of muted trade on a Friday, especially ahead of non-farm payroll data in the United States. We do have a bit of a read coming from China today. We also have an update coming from the RBA. They'll spell out their expectations for the economy, both locally and globally, and also their expectations for the Australian dollar. Where's your focus going to be through trade today?
Yeah, at the moment we're currently calling the local market down 0.7% at 4,385. So considering the fact that Japan's been called down 1.9%, and as well the fact that there's a fairly big dividend coming out of the market to the tune of around 11 points with the likes of Westpac trading ex-div, then it's not too bad a result at all. We've got BHP's ADR pointing down about 1.2%. Of course, like you were saying before, iron ore actually gave up ground for the first time this week, I think. So that's a bit of a negative for the market. But I think all this data has the potential to move markets significantly. But I think caution will be warranted ahead of the non-farm payrolls and further tapering talk later on today. From China, I actually think the key reading to look out for will be potentially the CPI reading and the impact it will have on the PBOC and its monetary operations throughout the day. Of course, they've started scaling back significantly on these recently, so the impact that will have on whether or not the PBOC is happy to maintain its current rate of easing is probably going to have a bit more of an impact on markets as opposed to all the other data points that are coming out of China.
Okay, Stan, pleasure to speak with you. Have a great weekend. We'll chat with you next week.
Cheers, Nadine.
Stan Shamu joining us from IG in Melbourne. And Stan was mentioning that we are expecting to hear from US Fed Chair Ben Bernanke speaking at an IMF conference. And we've heard from one of the RBA's heavy hitters, Assistant Governor Guy Debelle, through the overnight period. And again, we're getting more